If you start investing in stocks at 20 years old, even if you just have invested $100 a month every single month compared to somebody who starts when they're 30, like that 10-year difference is such a significant impact on the compounding effect.
Think of how long it would take for you to find another job. If you couldn't leave your job, do you have enough cash to float yourself 3, 6, 12 months? The closer you get to retirement, the more cash on hand you should have.
Welcome back to Peak Profits, the show where we break down the strategies behind building scalable, resilient, and recession-resistant wealth. Today, we're welcoming back Whitney Elkins Hutton, Director of Investor Education at PassiveInvesting.com, founder of AshWealth.com, best-selling author of Money for Tomorrow, How to Build and Protect Generational Wealth. In our first episode, Whitney walked us through her journey from accidental landlord to private equity leader and broke down the fundamentals of passive investing. If you haven't listened to that one yet, go check it out. But we're very excited to go deeper today. We're going to talk about portfolio design, risk management, billionaire investing principles, and how high earners can build a truly fortified financial foundation in 2026 and beyond. Whitney, thank you so much for joining the podcast yet again.
Thank you so much for having me on. This is going to be fun.
Yes, we're looking forward to it. Obviously, you have a ton of experience and background in the space, as we talked about and got into depth in our first episode with you. And so really want to pick that up. It's probably been 5 or 6 months since you were on the episode last. Has there been any big changes in your perspective? Have you switched into 2026 on the outlook of real estate and passive investing since we've last talked?
I think we're still, when we look at passive real estate specifically, where I'm at, like in the residential real estate arena, we also do self-storage, express car wash. So we do cash flowing businesses as well. But, for multifamily, I feel like when we were speaking last, we didn't know if we were at the bottom of this recession that we've been in for multifamily. I know we haven't called a recession in the United States. It's boggled my mind how we haven't. But I guess when you get to manipulate the numbers for yourselves, that's just kind of what happens, right? But long story short, I think kind of the consensus is amongst economics people that are, well-versed, larger purchasers of multifamily, that we're kind of nearing this bottom. Now, it's still a interesting time to get in, but I think, in 2026, we're going to see the end of what we call extend and pretend on the lending side. I think we're going to see deal volume start to amp up. I still think there's going to be real pain in the multifamily market, as some of these deals, cycle out. But that'll actually, there's somebody here that is really versed in stocks, bonds, and mutual funds. Sometimes whenever you're absolutely done with the stock and it's cratered out, you can actually sell and then switch your position into another stock, go from the bottom, harvest your losses, and then go into another position and allow it to grow. I think we're going to see some of those mechanics play out here.
Yeah, and I think that's exciting for those who maybe haven't got into the passive investing space yet, because, coming out of what we've seen maybe the last 36 months and really the rise over from 2014, call it, to 2022 of how hot multifamily was, really where the prices were that some of these assets were selling for in 2022. And in hindsight, you look back, you're seeing a lot of discounted assets now in relation to where they were maybe 3 years ago. You saw a very quick increase in interest rates, the quickest increase that we've ever seen, right? And so it did cause a lot of blood in the water for the last few years with people that maybe weren't in the best position within their portfolio. But we do have a lot of listeners on this episode and on this podcast that work in tech and work in sales that are looking to really weigh their options today, potentially investing passively or investing actively, like we talked about last episode, or exploring this passive route and really finding good operators and putting their capital to work that maybe is not as time consuming for them. And so we'll get into that today. And really, you talk a lot about building that fortified financial foundation. And so when you talk about that, what does that mean? So if you talk to a lot of investors, right, in PassiveInvesting.com. If you were to design a portfolio for someone who maybe came to you first time, a high earner, 300, 400K plus a year, that is sitting on some cash in today's environment and looking to explore some of these real estate investments, how would you approach them, and kind of what advice would you give them to start?
Oh my gosh, there's so much to unpack there. One thing, anybody that's starting off in, going to invest passively, whether they're going to do it into residential real estate like multifamily, whether they're going to do it into like self-storage, express car wash, or even real estate debt, you first, I would, have them get really clear on two things. One, get a good handle of what your current portfolio looks like. And label each investment. Okay. Maybe, if you're owning individual stocks, okay, you can lump that all into equities type investment. But when you get this, investment tracker all kind of, because you're going to need it moving forward anytime you add a private equity investment to it. I also would encourage them to actually label each line once in all the investments and put them in a bucket, right? This is just back of the napkin type math in a way. But, one is that particular investment or allocation of capital. Is it your liquidity and reserves, right? Is this your oxygen mask? Should things go sideways or south? Should you lose your tech job to AI or whatever? I know that's a huge conversation that, probably a lot of listeners are facing. Is it an income bucket? Meaning, does that investment actually produce reliable, predictable income, regardless of the underlying asset performance? And this is where I really love note investing. I love, more importantly, debt fund investing, which is aggregated note investing, because, we'll talk about risk exposure here in a minute. For those who are not accredited investors, cash flow bond type investing can also be kind of satisfy that arena. Okay, but remember that income layer is not tied to the performance of the asset, meaning there's a borrower, you're in as a contractual payment to you as the lender in order to get income. And then, give it a number 3. So 1 for liquidity and reserves, 2 for, that income layer, 3 for equities. And this is where it gets really fun, because 9 times out of 10, when I'm talking to any investor and they bring that type of structure to me, they're like, they've got, maybe 3 months of reserves in the bank, and then they're all equities. Stocks, bonds, and mutual funds, which, guys, are all correlated right now. Okay, they go up and down together. Okay, it's performance-based valuation. Your owned real estate, your private equity real estate, and then we're going to give a number 4 to our precious metals, our Bitcoins, our foreign currency. Those things are just hedges. I actually eliminate them from the investment pool entirely because, it's hard to gauge. They're meant to gauge, be a hedge against like currency loss or like valuation of the dollar, if it goes down. But anyways, we're going to put those in a separate bucket. And so that's kind of step number 1. Get a handle on what you got. What is your risk profile attached to there? Okay. And that's back of the napkin. We don't have to engage a financial advisor to do that. Okay. You're going to have something glaringly jump out at you. Simultaneously, I want you to think through your investor thesis. Like, what are your goals? Okay. What risk are you willing to take? That's your tolerance. What risk can you actually take? That's your capacity. Okay. And then think through your timeline horizon. All right. This is where I see a lot of investors got mismatched, right? They're like, I'm willing to jump out of an airplane and figure out and build a parachute on the way down, but I only have $100,000 in my bank account. Okay. That's not so high risk tolerance, very low capacity. All right. Another place where investors got, completely misaligned is they're like, hey, I want to leave my job in 10 years. So they go into equity, which is performance-based, and they forget about adding the cash flow layers to their portfolio, like through debt funds and note investing. Okay. So we got to create alignment. So those are the first 2 things I would have anybody do before they ever talk to an operator, look at a deal. But what are we trained to do? We're trained to chase yield, right? Just think about all that marketing, Vanguard, Fidelity, Schwab, Ameriprise puts out, like, go to school, get a good job, right? Contribute to your 401k, put your 401k in the stock market. 40 years from now, you can retire.
Yeah, it's so true.
Engineered portfolio architecture. I am not leaving this to chance.
Yeah, it's so true what you've just shared, and I personally have been through that exact same kind of process myself. I was very reliant on stocks. Essentially, like that was pretty much 100% of my portfolio. I had cash sat really doing not a lot for me. And it was really understanding what ultimately are my goals, because everybody has, or most likely has, the end goal of either replacing their income or retiring or no longer being reliant on their W-2. But it really is, how do you get from point A to point B? And the time frame that takes, it doesn't happen overnight. It takes consistency. It takes time. This isn't about getting rich quickly and suddenly hoping that every investment is going to 100x your portfolio. So what you're saying there is like rings true for me personally, but a lot of people that we speak to as well. What are some of the most common mistakes that people make, Whitney, when you're asking them these questions, when they're trying to identify in which of those four buckets do these things sit? Is there a certain area that people misunderstand and are either mislabeling them, like you're talking about there, people mislabeling potentially what bucket? That's actually performance based. It's not really a cash flowing asset unless X happens. Like, can you talk us through like some of the common mistakes that people make, but then also how you would help them like reframe that into a way that they would have a clearer picture of, okay, this is truly where you sit today. And now we've built that foundation that we can start to look.
Absolutely. And Brian, I realize you mentioned you wanted to talk about Fortress balance sheet. There's some similarities in the framework I just gave to a Fortress balance sheet, but we can stick a pin in that later because there's some other like foundational financial movers that we want to have, fortifying the foundation before we actually get into an investment. But I think mistake number one, Chris, not investing from a position of strength. Okay, so making sure that we have our oxygen mask on. Do you have, think of how long it would take for you to find another job, right? If you couldn't leave your job, do you have enough cash to float yourself 3, 6, 12 months? The closer you get to retirement, the more cash on hand you should have. Not to necessarily float retirement, but so we can, limit what we call sequence of return risk from the portfolio, whether it's your stocks, bond, and mutual fund or your equity investments. Okay, so that's number one. Number two is misalignment, right? I can't stress enough, so many investors that I speak with, they come to me and they actually haven't thought about the core part of what they want from their portfolio. They hear about all the cool returns and tax saving benefit, like they're selling their business, and they can, potentially offset the sale with, the depreciation from real estate. They can sell their, the single family rental portfolio and go into passive portfolio and no longer be a landlord, tenants, termites, and trash. That is amazing. Yet we don't want to let the return or the tax tail wag the dog. Like we need to get that alignment there first and really, drill down. Is what you are seeking as an investment truly what you should be going after? And then understanding what the different risk profile is. I think a lot of people, myself included, went into, multifamily deals and just kind of banked on the cash flow from these deals in order to kind of fund that tier 2 layer. And that until it doesn't, that cash flow compresses. So even as a passive investor, right? This is where I usually get the argument from somebody like, hey, I can go into stocks, bond, and mutual fund and I still get a dividend. No, that dividend can compress too, right? Things change. My JEPI allocation, that dividend dropped from, in the past year from just under 9%. Now it's down to like around 7.5%. Like that's over a 12% drop in cash flow. That's not 150 basis points. That's a 12% reduction. I got my income cut by 12%. Like who wants that in correlation to inflation, right? So my income for that particular investment got chopped by I don't believe it's 14%. I think it's much larger than that if we've calculated the impacts of tariffs to everyday households. But anyway, so we need to figure those puzzle pieces out. Like why, where does the true risk lie in your portfolio? What is your investment thesis? Do you actually understand the risk going into private equity real estate? Where do we peel off the cash flow? How do we handle that? How do we handle the equity portion? And more importantly, I think just the biggest mistake that I've seen investors make is to really ignore that cash flow layer. Because if you invest in the cash flow layer, is that the most tax optimized layer, no, that's not what it's there for, guys. Totally not what it's there for. But you can get equity like growth from that tax layer, or sorry, from that investment layer by allowing it to compound, by actually maybe putting that allocation into your self-directed IRA, either a Roth or traditional IRA, and allowing it to compound and grow there, right? If you don't need the cash flow today, let's put it there and not touch it for several years. And one of my favorite exercises is to go to the investment compound calculator, the government investment compound calculator, and to put in a, say like, a debt fund that yields 8%, and then put the timeline, allow it to compound quarterly, and put in the timeline for like 30 years. And you can even stretch it out if you're going to do a Roth and you're going to pass that Roth on to the next generation, put in 50 years. Like, yeah, $100,000 can grow pretty rapidly. So you don't have to take all the risk. Now, I'm not saying go just into debt. That's not what I'm saying. I think we just have to make sure, to build a balanced portfolio to where you do not have to, you can allow your equity assets to compound and grow, and you can cover your basic needs with your liquidity and income layers. That's what I'm saying.
Yeah, that's really good stuff. I went on to that government website as you just mentioned that, right? Like, and put in a $50,000 investment at, I did a 10% interest rate or a 15% interest rate. And it is crazy to look at the difference of what you can get. I mean, 15% is really high in a debt fund, but 10% is probably where, there's funds out there that you can get that and compound your earnings, call it over 15, 20 years. So it is interesting to look at because a lot of people want the cash flow now. They want to double their money in 2 years, and it's not realistic. And if you look at the compounding effect of it, if you are patient, it will jump out at you and be like, oh, wow, like just be patient and trust the returns that you're going to get and how you're kind of divvying out your portfolio. And I think that's an important call out. So you did mention the fortified portfolio or the financial foundation. You want to touch on that quickly before we move on? Your view on that and what that means?
Yeah, so just some quick insight into that. I mean, these kind of seem like basic moves, but I think a lot of sophisticated investors, they're looking for the next deal, the next headline, right? And they forget that a lot of times the simplest things they can do to produce wealth are already within their reach in their own portfolio now. So basics, okay, tracking your income and expenses, very simply. Stay in your relationship with that and making sure that you are not keeping up with the Joneses, that, and again, this is boring stuff. I mean, somebody's like, okay, I'm going to turn off the podcast. Don't, please don't, because that can be super powerful. I often help investors find $5,000 plus a month between, if they have like an operating business and their personal expenses. I mean, you take $60,000 a year and put it into a note investment at 8%. Brian, you just did it for $50,000 at 10% and just let it ride for 10 years. That in 10 years, that's $1 million year over year, right? Because that's 60,000, not that you recouped once, but you're recouping year over year over year. More money for you to save and invest. Okay, 2, tracking your net worth and balance sheet. I think, a lot of people forget about the gap, they fall in the gap and then gain. If you've ever read that book by Dan Hardy, or Dan Sullivan, sorry. Long story short, you need to know what progress you're making year over year. Most go-getters, I assume, that are listening to this podcast, they think they're treading water and they're not making progress. But if you're tracking year over year or quarter over quarter, you'll see the small movement, and it's all about being directionally correct. Then we get into making sure that you're eliminating the big horsemen from your portfolio, right? Using debt wisely, making sure that we're outsourcing our liability appropriately with insurance. We're not paying exorbitant fees when it comes to buying real estate or even within your retirement portfolio. You can go on a calculator like underempower.com, put in your stocks, bonds, and mutual fund, And it'll show you that you're going to lose 31% of your portfolio to just the normal expense ratio and the 12B, what is it? The 12B-1 fees. 31% of your portfolio. Why on earth would you do that? Right? That's, you know, for some people, like 3 to 5 years of retirement right there that they could recoup hundreds of thousands of dollars. So these are, you know, these are some basic things. Making sure you have emergency reserves set aside, right? It's not a matter of if you're going to have an investment being challenged, it's a matter of when, right? And so you want to have that ability to be flexible. I think a lot of us think of our emergency reserves as something we're never going to touch. I hope that, but that's not the reality. That's not why they're there. Okay. It's kind of meant to be a living account. Money can flow in and out. If you take money out, that's your first order of operations, replenish the account. Home equity line of credits. If you own your primary residence, get your lines of credit open now. You know, banks are always willing to lend to people that don't need the money in a time when they don't need the money. So get the line of credit open now. That way, when you do need money,
right, just let it sit there. If you don't use it, you don't use it. But yeah, I completely agree.
And, you know, that could be the same for credit cards and stuff like that. My fave is the home equity line of credit. You know, you can renegotiate that every 10 years. Heck, you can even do it more often if you wanted to. There's a little bit of drag of doing that. You know, sometimes the biggest reward, effective rate of return, is actually paying down your debt. I think we hear that, you know, Susie Orman, Dave Ramsey school of thought. We hear that all the time. Yeah, okay, pay off my debt. But, you know, when you're looking at investments and you're kind of going, ooh, I don't really see anything out there right now. And you've got $5,000 sitting on a credit card that you don't have paid off, you probably have a 25% effective rate of return if you got that credit card paid off.
Yeah, I think what you've shared there is like people being good at the basics goes a long way. I know Brian does this too. I track my net worth every single month. I go in there, and when you tell people that, they often go, oh, you must live a really, really boring life. Like all you're doing is checking digits and numbers. But the reality of it is the whole point of that is not to be boring. It does go up and down. You might go on vacation and you spend more than you thought you were going to maybe spend. So it dips down slightly in that scenario, or something happens. You need to replace a hot water heater or a sink, or anything like that might have to happen. But it just puts you back on track, right? You're tracking it. So the next month, the next few months, you look at that and you go, how can I get myself back on track? And it's not going to change significantly month over month unless you, I don't know, win the lottery or whatever that might be. But it's over a period of time that it really starts to make an impact. And it's getting used to doing that I think is so important. And it doesn't mean that you're boring. It doesn't mean you can't live your life. It doesn't mean that you can't go about doing what you want to do. It just keeps you grounded in that goal of building your wealth over a longer period of time. So I think that is fundamentally one of the biggest things. I also think a lot of people overlook the emergency fund, right? Or as you keep calling it, your oxygen mask. The amount of times, and especially in the current environment, people's jobs are at risk. You see massive tech organizations making layoffs over the last few years. That's impacted a lot of people. We personally know, probably all three of us on this call, people that have been impacted by that are fantastic at their roles, very, very successful in the past. And it's taken them 6 to 12 months to actually find another opportunity. It's very, very difficult to sustain that if you, don't have an emergency fund. But even if you do have an emergency fund, that can deplete very, very quickly if you're unemployed for 6 to 12 months and if you don't have your other investments structured in the right way. So I think people really, really should pay attention to that piece. Definitely not turn off the podcast at that point, because if you can get the basics right, it really does, as it says, it's the basics, it sets the foundations for what you're looking at. So once people have got the basics, they've got that set up, they've got their emergency fund allocated, right? Like, what is the next steps that you would guide people to go ahead and do, right? You've got your buckets allocated into those 4 key things. you've got your basics set up in place, you're tracking your net worth, you're tracking your expenses. Like, what do you then share with people that they should do next?
Well, kind of circling back to where we started the episode, the next thing would be making sure, let's concentrate on getting those four horsemen out of our portfolio. Because, the basics are going to help us catch the, $100 a month transactions, right? The four horsemen are going to help us catch the thousands, tens of thousands, hundreds of thousands of dollars that we need to recoup back in our portfolio. And then really quickly, and those two areas aren't sexy, right? For a high income earner, they're just like, please just get to like the investing part of the show. That's where we circle back to like putting together the investor thesis. What is it do you want? What do you already have in your portfolio? Have you already had investments that have been challenged? What did you learn from them? What are your rules? What are you willing to do to earn a return? What are you not willing to do to earn a return? And I always put it in the context of like the sleep well at night. Who loves investing in anything? I might be talking to the wrong crowd though. Tech workers tend to be, a little bit more higher risk than the average Joe. But, are you okay with the volatility of that particular investment? Like if it took a 30% hit and didn't recover for 3 to 5 years, would you be okay with that? Could you hold on to that investment and allow it to recover? Right? Those are all the questions we want to answer up front. Even when we go into passive investing, especially when we get into the equity piece, we want to make sure that we're, how much money are we going to allocate to an operator, right? I think in terms of portfolio percentages, somebody might be only willing to do 1% of their portfolio. Somebody else might be willing to do 10% of their portfolio, right? That's really personally based. How much are you willing to allocate for any one deal? Think through these questions up front because you're making these decisions with a cool head. Because when you have a deal in front of you that says 15%, Brian, cash on cash return, is it easy to make a cool headed decision? No, somebody's like, oh, I got to beat
I can't miss out.
Yeah, I got to get in, right? Try to make some of these decisions as in a cool-headed state. When you're looking at a deal, review it against your investor thesis, those questions you've already answered for yourself, those rules that you've already put in place. And yes, you get to change your rules, but it's a lot harder for you to go, well, I said I wasn't going to do this, but this deal actually does that exact same thing, right? Like you're knowingly violating your own rule, right? As opposed to making a biased decision. And then tracking your portfolio. That is another huge thing that a lot of investors, I wish they put more effort into tracking their private real estate investments beyond just going, hey, did I get my K1? No, tracking your capital account allocation, right? Like, yes, your CPA should be tracking your, the depreciation you get from your equity investments. But, when did you invest? Because we want to spread our money out over the market cycle. We don't want to be an all 2022 vintage multifamily assets, right?
Yeah.
Raise your hand if you have a lot of those, right? That probably didn't go over so well. But if you had 2015, 17, 19 investments and then had a couple of 2022, you're going to like, okay, over the averages, I'm still making a lot of money. So don't be rushed to deploy all the capital into an equity position, especially just for the sake of tax benefits. That's where we go back to like, how do we make sure we've got those, the tier 1 liquidity and reserves and the tier 2 income taken care of. That allows us to be patient.
There was a lot there that I'd love to unpack between both you and Chris. Really, it's the importance of tracking, right? And understanding your net worth. And like, if you have even an Excel or a Google sheet of your assets and your expenses per month, your fixed monthly expenses, it's something that I do, right, each month. And if you have that each month and create another tab for, 2025, January through December, 12 tabs, here's the differences and here's where my net worth has grown, right? It takes maybe 30 minutes to an hour each month at the beginning of the month to look at where your assets are, maybe your account balances in your stocks and bonds and mutual funds accounts, and then really tracking where your passive investments. what distributions did you get the previous month and where are those accounts. It doesn't take that long, but you need to just set that foundation up to understand what you're looking at. And then once you have that clarity, then it will help you understand where to take your strategy moving forward. And the point that you just hit on, Whitney, being in tech, I've worked at Salesforce. We're going through this crazy transformation right now in the tech space with AI, and this new coined term of SaaSpocalypse. I don't know if you guys have heard of this, but software as a service, which is so many software companies, and Salesforce being probably the biggest software company out there from a licensed seat perspective. We'll talk about a roller coaster. I have a lot of employee stock within Salesforce, and I talk a lot about investing and diversification, and I might be a little overweight in Salesforce because of my compensation, but I've seen we were at $360 per share in December of 2024, and we're at $180 per share. And so if I have 500 shares in Salesforce at any given time, I might see that go from 140K to 90,000, right? And just emotionally, right? Do you want to hold on? What does that look like? Should I sell off each quarter to start to diversify where that capital goes into different buckets? And it is something to think about when you're in the tech space and how your foundation of your portfolio looks. And so that's a really good point. And I think for those who are listening and those who are in tech, it's thinking about if you have high RSUs or restricted stock, options or employee stock purchase programs, and you're still super bullish on maybe Google or Microsoft or the outlook of your company, you should still think about diversifying out into other asset classes or forms of investing, maybe real estate backed for some of that portion as well to help diversify your portfolio overall. So really good stuff. And with that said, you've worked with so many people. Maybe most of the people that we've talked about are doing very well, but maybe not ultra wealthy, right? They're still W-2. What have you seen the difference in when you talk about, high income earners, W-2 employees, maybe a couple $1 million net worth, to $20 million plus ultra net worth portfolios? How are they thinking about money? Because once you start to get there, I think it almost becomes more important about capital preservation and protection of capital, and then prioritizing where that growth is going to sit and where that diversification is. So can you talk about the difference of maybe successful people now, maybe $1 to $3 million net worth, to the $20 million plus that you've seen, and how they think about it differently in the sense of investing?
Yeah, I'll agree with that. And I'll stack on something you just said about, people that have a lot of ownership in their company, when it comes to like restricted stock. So to answer the question directly about, the people that are, probably, we call them qualified purchasers, 5 million net worth and above. And definitely, the mindset shifts as you go higher just a little bit. But, those investors tend to be, they begin to understand that it's more about playing defense than offense. And so they understand that it's also about cash flow too. And that's what I wanted to speak into with the restricted stock piece is what buys freedom. It is not, it can be like if you're going to build up a whole pile of like a huge net worth and then you're going to like stop investing and just like draw down on that. Yes, that is one strategy. But if you're going to leave money to the next generation, it's actually what kind of cash flow, predictable income is your portfolio, kicking off. And, that is a huge lesson that I, one, learned the hard way. And two, like in the investment communities that I'm in, I started really looking at this because the people that, have like a 1 million to 5 million net worth, they're still in the accumulation phase. That conversation is very different. They're trying to build. They're how much more I'm going to wait for that value of that stock to go up. I'm going to wait for my multifamily to rebound. I'm going to wait for my single family, valuation to rebound before I sell. Can you hold on that long in order to do it? But once you've accumulated the assets, that group starts peeling off a portion to give predictable income that covers their lifestyle expenses. So the remaining part of the portfolio can compound and grow. So if they have $7 million, they might peel off, $2 to $2.5 million and get it to kick off $200,000 to $250,000 a year. And the remaining part of their portfolio is compounding and growing. They might still get a little bit of cash flow from that, but they can be patient. and allow it to grow. And they understand markets go down, they understand market cycles, they understand credit cycles. And so that's really the big difference is one, how they structure their portfolio, how they treat that income layer of their portfolio, and then two, how they understand the length of the market cycle. They're not swinging for the fences to try to cross their fingers that a deal exits in 2 to 3 years. They understand if they go into a private equity, and they do a ton of private equity, that's going to be 5, 7, 10 years, maybe even a perpetual hold.
Yeah, and I think again that really goes back to this. It doesn't happen overnight, right? Like these people are looking 10, 15, 20 years out. Even in you just mentioned there, even looking generations beyond themselves, which again is 20, 30, 40, 50 years beyond where we're sat today. And I think that's such an important piece is, yes, you should start today. I think there's I don't know the exact maths off the top of my head, but it's like if you start investing in stocks at 20 years old, it's such a significant jump that your earnings or that your portfolio will hold, even if you just have invested $100 a month every single month compared to somebody who starts when they're 30. Like that 10-year difference is such a significant impact on the compounding effect of this that it really is important just to start and be consistent with it, but ensuring that you're not swinging for the fences is such a great analogy for that, right? Because there are going to be deals that come across your desk. It looks like the next shiny object. People do get shiny object syndrome, right? And it's how do we go from all of these key areas? And it's about making sure that they actually achieve what's on those PowerPoints and on those marketing decks. And it doesn't necessarily have to be the highest number. Right? Like you don't have to invest only in the biggest numbers that you see. There could be other deals that are projecting lower numbers. They may overperform those numbers. At the end of the day, all of these are all projections, and you have to do what really you can control in terms of a risk mitigation strategy around it. So that is something I now want to kind of jump into, Whitney, is risk mitigation, right? Because you said what a lot of the ultra wealthy do is go on defense instead of offense. Like, what are some of the most common defensive strategies or risk mitigating strategies that those ultra wealthy people will use and leverage? You've kind of talked about them siphoning off some of that compounding and focusing that on cash flow whilst letting the remaining continue to compound. And I'm sure over time they continue to siphon off and build up that cash flow. Like, what are some other areas that the ultra?
So, well, number one, they're investing in themselves and their own knowledge and their network, right? So they're not comparing deal decks. I mean, they are, but it's more about who is running that, right? They might actually get themselves in the ultra, high net worth. We're talking like, 5, 7, $10 million. They might be able to get themselves into a key partnership position, right? Because they have enough capital. And so that earns them a spot in the GP, right? And so, but it all goes, they have to have the knowledge, they have to have invested in themselves in order to get in that position. They also look at capital allocation across the capital stack. And so this is another, it's going to be akin to like the risk buckets, right? But, they've got allocations into, senior debt type positions. Maybe it's a bond, position. Maybe it's an actual, investing in notes or note funds, right? It could be public markets, private markets, right? They got allocation into senior debt positions that are kicking off cash flow. They'll take a little bit more risk in the mezzanine position. Those are contractual payments to them, right? They're not a partner in the deal, right? They might be called a limited partner, but in essence, they are a bill to the deal, right? Whatever deal they went into. And then they understand, that when they flip into the preferred equity positions, common equity positions, now they're in a partnership suite, right? Their deals are based on performance. And so they're going to evaluate the deal, not on the pro forma, sure, returns, yes, but more importantly, who is that person running the deal, right? What's their, their track record, background, experience, character, right? right? That's been the huge learning lesson for a lot of operators the last handful of years, last 3 or 4 years. I mean, a lot of people, operators had their assets challenged, right? They were mismatched with the loan that they put on the deal for the market that occurred in front of them, right? There's only so much you can control. The market is not one of them, right? The market appears when the market appears, right? You just hope you had enough tools in the tool belt and a long enough view like outward to see what markets were heading your way. So, but what was the character of that operator? Did they poof, right? Did they commit fraud? Did it turn into a Ponzi scheme because they just couldn't, face reality? Those ultra high net worth, and this is a lesson we can all learn. We should look at who are these operators that are still here and do business with the ones with high character. So they invest in themselves. They look at investing all across the different layers of the capital stack, and they're building those deep relationships and partnerships with, the operator. And that takes time, right? Some of these ultra high net worth might go into what we call a fractional family office, or they might actually start their own family office because their portfolio is so vast. And they're building those relationships over a year or two, right? Like we've been to conferences with, family office advisors, and, we can't get in front of their constituency probably for a year, right? Because that family office advisor is just like, hey, it's with me, and I'm going to get to know you. Like, I'm going to know your kids' names. I'm going to know your dog. I'm going to see what you're posting on social media. Like, we're going to be BFFs before I ever bring you to dime. Mm-hmm. Right. And I'm going to know everything about your company, like what you've done, what you're going to do. We're going to look at a lot of deals together. Right. So those deep relationships, and it's because they have the patience to do that. Right. They're not, they've hit such a large net worth that they bought back their time with the cash flow, right? That's what gets you your time back, is the cash flow. It's not necessarily the equity, right? Because the equity is always going to be based on performance. They bought it back with the cash flow, and they can be really.
Yeah, I think that's important too, because these are long-term partnerships if you're in an equity deal with these operators through different market cycles. From what we've seen over the last, if you've been in a deal for 5 to 7 years, you've been through quite a wave of change, right? So you have to think about that going into it. And a lot of it is who is running the deal, and the character and the people and the team that they have built out, right? Are those people that you're going to want to work with and stay in contact closely with for the next potentially decade, right? With all that said, what is an asset class that you would double down on today, and why? And then what is one asset class that you would maybe still avoid in this time and place in 26?
Well, two of my faves today is, still the debt side of things, like, our real estate backed debt, fix and flipping. I mean, we have such, a need to bring, that 1960s, 1970s, and even 80s vintage of a house, upgrade it, continue to make affordable housing here in the United States. I mean, we could spend a whole podcast on why that is, investing in that area is huge, right? Like that is a need that's not going to go away for the next 10 to 15 years, right? Or maybe even 20, right? We are so challenged in that area. Especially as the baby boomer generation downsizes. We've got massive competition for these smaller homes. The McMansions, I don't know. We got to be very, aware of that type of investment. Also, I think this is a great time to get in, start taking a look, right? Start getting your feet wet over the next 6, 8, 9 months on multifamily, right? We are in the beginnings of the recovery, which means you don't have to deploy all the capital right now. Please don't deploy all your capital into that right now. But this is, we're in the spot in the environment where, we've got a nice runway, maybe the last runway that we had was 11 years of investing in multifamily. All right. Will it be 11 years? I don't know. Maybe it'll be 4 or 5. We've got time to allocate into that. An asset class that I would stay away from. You know, I don't like throwing other asset classes under the bus. I have some very, great friends in all areas that are doing amazing work. I will say the last data that I saw on where we're heading with industrial, especially when it, lines up with, our current trade policy, trade agreements, as well as, how AI is impacting it. I'm curious to understand if we're going to be able to keep up, if we're oversupplied, if we've actually kind of swung the pendulum the other way. 4 years ago, that wasn't the case. We needed industrial space. Are we oversupplied now? I don't know. And that's something that I am keeping an eye on.
That's amazing, Whitney. Those I completely agree with. Definitely the debt side and the multifamily side. I currently have been moving a lot of my funds into both of those, so I can't say I disagree on that in any way, shape. This has been another fantastic episode. We're already here at 45 minutes again. Feels like we've only been talking for 5 minutes, and with so much incredible content coming out of it. I just want to say again, a huge, huge thank you for you joining us on the podcast. Where can people reach out to get in touch with Whitney, to get on a call, to have you break down their portfolio, to pick your brains on everything passive investing? Like, how do people get in touch with you?
Yeah, you can reach out to me at passiveinvestingwithwhitney.com. Short form there, and that'll get you the link to my call calendar, and I would love to hop on a call.
Amazing. Well, again, I just want to say a huge thank you, Whitney. We'll put Whitney's link into the show notes so that everybody can click on that very, very quickly. But again, fantastic episode, Whitney. For anybody listening, please do like and subscribe to the podcast. It's the second time we've said it now. This is going to become a common thing at the end of the podcast. We're going to keep counting how many times we've done it. But again, huge thank you from both myself and Brian.
My pleasure.
Thanks, Whitney. We'll talk soon.